Hello, welcome to day 15 of my trading journal to help with my learning and understanding of ICT concepts. And this is just going to be a personal review of some of my trading journals. Some of these are from an actual funded evaluation challenge with Trade Day. Some of them are just me putting in some extra hours in TradingView. And so I'm just going to go through here and just try and recap on what I did to make it easier to remember. I've been watching quite a lot of my own tutorials just to kind of help me remember everything I've been learning, and of course I've been trying to simplify my rules as well, which we'll get into, because the journal up to this point has kind of covered quite a lot of stuff, so I'm trying to bring it into some simpler concepts that are easier to follow. So what are we looking at here? We've got the daily equal highs here, and so I think what happened here is I'm going to just have to read it, see what happened. I gambled one micro contract on what I thought might have been the Judas swing. So I thought that this was the Judas move above equal highs. This approach has not been very profitable in the past. I avoided going on tilt, and when my 2020 setup formed, I used 2 contracts and managed to trade into a low-hanging fruit objective. Okay, so I keep having all these rules that say wait for this to happen, wait for this to happen, but like all I really want to do when I'm trading is when I see like an area of liquidity being raided, I like to try and anticipate that, and try and catch the top of it, but that obviously doesn't really work very well, because sometimes price can just keep making new highs for ages. Anticipating price was more difficult because on one hand there was bullish price action originating from a higher time frame price origin, but the Nasdaq had also just taken all of the sell side liquidity. So there was no more sell side liquidity up here. Until a new weekly narrative becomes clear, I should just target lowest hanging fruit objectives. Okay. It didn't have a strong daily bias, so I wanted to see how price would react to the previous daily high. So yeah, about about an hour into trading, I just get impatient. I see what I think is the liquidity being raided, lose a micro contract there, then realize I have to actually wait for a market structure shift, or I just keep stubbornly trying to look for short opportunities and refuse to recognize that maybe the market is just on an uptrend. So that's been one of the biggest hurdles. So I appear to have identified a bearish breaker. Liquidity gets raided, then price makes a low, a high, and then a lower low, which is the market structure shift, and then price retraces up into a fair value gap, which also coincides with the midpoint of the bearish breaker. So it was an okay trade, I guess. It followed the rules. The stop loss was originally here, but this played out over the course of about 2 or 3 hours, so it kept coming back up here. So I actually moved my stop loss here, and luckily I didn't get stopped out, and it did go and hit a profit target. So yeah, this was actually in the funded evaluation. I think this was day 1, so that was actually real trading. Then I don't think I recorded day 2. Day 2 was where I sort of gave back the profits and went back to break even. Then this was day 3, and this is what prompted me to do another round of back testing over the weekend. So let's just see what happened. Once all the sell side liquidity was swept, there was a 15-minute fair value gap and a market structure shift on the 15-minute time frame. Lastly, once a trade that meets all the rules is committed to, the original stop loss must be respected. As in this case, the analysis was correct, but the trade just needed a bit more room to play out. Okay, so I think that's referring to this one here. So the sell side liquidity gets run. I start looking for, there's a market structure shift here, pulls back into this fair value gap. Had the stop loss here originally, but once I saw failed to make a lower, let's zoom in a bit, failed to make a new low. They made 1, 2, 3, 4, 5 green candles, made a market structure shift high. Rather than waiting for price to come up here, I just, reduced the stop loss and, well, I just exited the position. So then it took this liquidity again, made a stronger market structure shift down here. Then it came back up into this 15-minute fair value gap. So entered here, stop loss was up here. However, once I saw again failure to make a lower low, came back up, made what I thought was a market structure shift here. So I got nervous then, and then I just exited the position as soon as I saw price going up like this. But really, what this is saying is that, you just have to wait until you just have to put the stop loss where it needs to be, which is an area that would invalidate the trade, because obviously, that one, at least the analysis was, actually correct on this one, had the right idea, but obviously move the stop loss. This is obviously, again, this is me. Feedback, pay attention to the origin of price delivery. For example, price delivering from the 4-hour fair value gap during the morning session. Price was also below the New York Open. So after the London lows were swept, it would only have made sense to look for longs. Otherwise, it wouldn't follow the established logic of not selling after. Okay, so yeah, this was pretty bad, because we have these equal lows here. That's sort of your liquidity run into here. I didn't actually have this on the chart at the time, but this is a 4-hour fair value gap. And from, 6:30 to 8:30, the bodies are mostly respecting the mean threshold. And if you went out to a higher time frame, you'd see it much more clearly. So once price started actually moving away, that is price originating from a 4-hour PD array, bullish PD array, respecting it, very clearly. And then this move down here, the bodies still mostly respect the midpoint, but the wicks just collect this liquidity here, and price goes up, and that would have been a very strong indication of bullish price action for the morning. However, all I had was this, I don't know what I had actually. I must have had, this must have been a 1-hour SIBI, and then once it got violated, I changed it to an inversion fair value gap. So this was originally red. I thought price would reject that and move down, but instead it violates it. But then it comes back down and uses it again as an inversion fair value gap. So yeah, that was a pretty bad loss. So yeah, pretty bad day there. So let's go and look at the next day. This is, I think this is just demo. I think from everything from this point is just me trying to get into more practice in trade day. Because I got a $10,000 simulated account with trade day, and it's down by about $140, because at least I've been just doing 1 or 2 micro contracts, not too much damage that's been done yet. Okay, so let's have a look at what happened here. So we've got, just ignore that's a fair value gap. I was trying to say point of delivery as in origin of price delivery. I mistook the raid on buy-side liquidity as a market structure shift because I didn't have the 1-hour fair value gap marked out on the chart at the time. In the future, I'm going to trade in the direction of the origin of price delivery, as I think that trumps the New York Open. So rather than just blindly saying, oh, it's above the New York Open, therefore I'm only going to look for short positions, instead I'm basically going to just throw that out and just rely on origin of price delivery. I have been trying and failing to catch reversals because I keep confusing liquidity runs with market structure shifts. So yeah, this has been a big issue. You know, ICT talks about the market structure shift. So, you know, we get a wick below there. That's a market structure shift. So the idea is that price, this is going to then come back up and then, but the problem is, this market structure shift could just be a liquidity run on here. And then because I didn't have this PD array on the chart at the time, I wasn't aware that it was, you know, respecting the mean threshold of this. So then when it came back up, that's actually showing us that this is now the new origin of price delivery. And obviously it kind of goes through there. Technically my stop loss should have been here, but I put it here because it was just too far, and then I increased it a little bit, and then realized that's just too much. So yeah, and then from that point, you know, price comes into this here would be a bullish order block, so price comes back into there again, then it creates a fair value gap, trades back into there before going higher. But of course, once it gets this high that quickly, you start to worry that you'd be chasing price. At the beginning of each day, regardless of the New York Open, regardless of my own personal beliefs about how high or low the market might go, I am simply going to identify the higher time frame point of origin and choose that as the bias. Then I am going to mark out all the liquidity zones and check to see if they reside next to any 1, 2 or 4 hour or 30-minute fair value gaps. For example, buy side liquidity resting above a 1 hour fair value gap would be an area of interest if I missed the initial sweep and price reacts to the mean threshold. So here we have clearly buy side liquidity, and what is below that, a 1 hour fair value gap or displacement. And so price efficiently takes out two birds with one stone. It collects the liquidity and corrects an imbalance. So that's something that I'm sort of paying closer attention to now. In fact, the 2022 strategy is sort of morphing into a different strategy that revolves more around understanding origin of price delivery. I have started adding directional arrow. Okay, so yeah, once price reacts to the mean threshold, it's pretty significant when that happens. Just trying to help visualize it on my chart, you know. I've started adding directional arrows to the higher time frame fair value gaps. These literally show the direction of the market because they represent the point of origin. I haven't been respecting them yet because I was getting hung up on the New York Open price, but from now on they are the be all and end all of bias for the day. So rather than having just a bullish or bearish daily bias for the whole day, it would be instead based around liquidity, higher time frame fair value gaps that have their mean threshold respected, which then become like, you know, so for example, if we start trading here, our bias would be bullish until we see, a bearish PD array being respected. So that's a fair value gap that gets violated. So, the only time we ever see a bullish PD array being respected is below on bullish. Every bearish PD array just gets violated. So in this example, price originated from the 1 hour fair value gap. We can tell this because the mean was respected and the body was never violated with the candle body. Plus it swept liquidity. In this case, I entered a large sell based on the 15-minute fair value gap SIBI. But from now on, the only thing that trumps a 1 hour point of delivery is a 2 hour point of delivery, or point of origin, whatever you want to call it. So this is at the point where I kind of start realizing that, this is going to be the main focus from now on. Okay, so can't remember if this is a real trade or a hindsight trade, but I should be able to remember as we read through this. Initially, I thought price might use the daily fair value gap as support, but after more consideration, I am only to use the mean threshold to help me identify the correct one to use. Since I don't know which ones will be respected and which ones will act as support, once I identify the liquidity, I will then look for fair value gaps that have already been respected prior to the session. For example, the 30-minute fair value gap had its midpoint respected 3 separate times. So that's this red one here. So we come in before the morning session, we see, 1, 2, I think even off screen there's another high that respects it, so it's 1, 2, and then finally 3 here, 4 if you count all these. The point is that is clearly, there's not imagination, it's not drawing triangle patterns, or there is clearly a level that keeps getting respected. And I guess it looks, most people would look at that and say it's an area of resistance, which I guess is fair enough, but we're basically waiting for that to be respected. So originally I was looking at this daily fair value gap, and I was thinking, oh, okay, the bodies are still almost in the whole area, but now I'm saying I'm only interested in the mean threshold. If it's a fair value gap that's larger than a 30-minute, then I'm only interested in the mean threshold. I don't even need to see the area. It's just a specific level. So basically this fair value gap, as far as I'm concerned, was actually violated, which was letting us know that price was going to go down or something. Once I identify the liquidity, I will look for fair value gap of 40 mean blah 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 blah. The goal is to find the highest time frame fair value gap that has had its mean threshold respected. Then simply wait to see if price trades to it again. Once it does, I can then look for market structure shifts and fair value gaps to enter on a much lower time frame, because at that point I will have a higher time frame narrative. So I was waiting for a market structure shift. Couldn't really see any fair value gaps, and then started to realize that this is not an area that's being respected. Then I see, so I don't take a trade, and then once I see this again, 1, 2, 3, 4, 5, 6, I don't just blindly enter there, but once I see price come down here, 1 or 2 minutes now, so we go into a lower time frame. That there, to me, is my market structure shift. Then I see this fair value gap, and then I just immediately enter it. We don't even need a very big stop loss because we're on such a small time frame. And then I just target this area of liquidity here, and that's sort of one of the first examples of this logic actually working out. These rules here continue to evolve over the coming sessions. Okay, just try and remember what happened here. When we see candle bodies respecting the mean threshold of a higher time frame PD array, that is significant. Ignore the wicks. Continue to practice identifying this when it happens, because it can be easy to miss. You need to check all time frames beforehand. Sometimes you forget to include daily and weekly along with hourly. So here we go. On a 5-minute time frame, we can see this daily fair value gap. Looks like it's not being respected, but if you only count the bodies of the candles, it very clearly is, give or take a few pips. So then price leaves it after respecting it, and of course, most importantly, after taking out the short-term liquidity. So again, that's the key thing I'm looking for now. It's for a buy side liquidity residing directly above a fair value gap. So it could be here, or it could be just above the midpoint. But it's those situations where the market does two things at once, takes liquidity and corrects an imbalance, and then moves away from it, and then we wait here to see a market structure shift. So that's 3 things: buy side liquidity, point of origin, sort of semi-confirmed with a market structure shift here. And then at that point we just drop down to the lowest time frame we need, 2 minute, 1 minute, basically find the closest fair value gap, put the stop loss at the previous low, doesn't need to be all the way down here, just literally, and then just get in the trade and just target the next area of sell side liquidity. Again, it's a low hanging fruit objective. If if this was all hindsight, I could have just put the take profit up here and tried to be like, look how well this works. But I'm being honest, I was just going for here, and just happy that I actually managed to. Because when I'm back testing on TradingView, I try to do it where I don't know what's going to happen exactly. So okay, let's go on to the next day. Another example of when we can clearly see where price is originating from. Even if we get to the chart late and it looks like we've missed the move, we can still enter, and the earlier the better. It might feel like we are chasing price, but look, we already swept external buy side liquidity. That's a significant level of external buy side liquidity. We already we already created a market structure shift. So before we got to the chart, the market structure shift has already happened here, and again and again. We already have the market structure shift, and our daily point of delivery, which is daily. Yeah, that's right. Point of origin based on a daily fair value gap. Again, the highest time frame fair value gap I can find. Already created a market structure shift. Our daily point of origin trumps any lower time frame fair value gap SIBIs that we might be concerned about. So say we see price approaching, say, this 2-minute fair value gap, and we're getting concerned that actually price is going to reject this and then push lower. And to be fair, yeah, that if we started here, we might think, oh, price might want to come down to this mean threshold, but once we get to 8:30, we can see price took the liquidity. It didn't quite get to the mean threshold, but it certainly has used this fair value. Oh, and of course there's a 4-hour fair value gap. So it's just barely violated the mean threshold of a 4-hour fair value gap, but we can understand why that might have happened, because there was also a daily fair value gap as well. So we've got the 4-hour, the daily, the two midpoints, and then the midpoint between them is, so it's like the mean threshold between a 4-hour and a daily fair value gap. If we had them on their own, would say, oh, it hasn't reached the mid threshold yet. If it was just the 4-hour, would say, oh, the mean threshold's been violated. But actually, we keep stacking up the fair value gaps on higher time frames just to, so we can understand why price, for example, maybe if we had a weekly fair value gap and the mean threshold was here, we might expect to see, maybe this daily mean threshold gets violated a little bit. So basically, the more bullish PD arrays you have on the chart, the better. So yeah, we get to here and we can see, oh shit, the move's already starting. There's no need to mark out buy side liquidity and wait for some pullback that never happens. As soon as I see this, I just say, screw it, there's a fair value gap on a 2-minute. I'm going to put the stop loss below here, it's, only 10 pips or so, and then I'm going to target the next area of sell side liquidity. And it felt effortless almost immediately after entering the trade. Within 15 minutes it just hit the target. But when you're on the wrong side of the market, you're waiting hours and price just isn't moving, and it's so check the chart beforehand, and when you're ready to start trading, don't wait for a huge pullback and miss the entire move. Instead, use the lowest time frame that allows an entry, which is what we did there. We can see our rules starting to be a bit more refined here now. There's no longer a separate rule set for breakers. I've just got the ICT model. We've stripped it down now, so we just need buy side liquidity to be taken, yes. Sell side liquidity hasn't been run yet, and that would be external only, because otherwise, you know, all of this is, oh, is that sell side? Is that sell side? Is that sell side? Only external significant sell side liquidity. As long as price hasn't reached there yet, then that meets rule 2. Rule 3, market structure shift, which happens here. Well, technically, any of these could be a market structure shift. And then with market structure shifts, I'm going to add a double check criteria. Confirm the market structure shift isn't just a rebalance of a previous higher time frame imbalance. For example, respecting the level of a 4-hour fair value gap, SIBI would not be valid. So we say, oh, we've got our market structure shift, but if there was like a massive 4-hour sell side imbalance here, and that was the mean threshold, then we wouldn't be able to consider that a market structure shift, because you know. Yeah, so that's that. This is where the rules are hopefully starting to get a bit more simplified now. I can technically use any PD array I want. I could use an order block, I could use a breaker, so that's why I've got them all written, but at the moment I'm pretty much just focusing on the fair value gaps here. So let's see what happened today. Okay, so this was the previous day, right? Price made this huge rally. Could have missed that, and so this is the following day. That's that rally here. And then after London, we get to the chart here, and we're thinking, oh, is this big rally over? This huge move over, it's already gone up so high. Can it possibly keep going higher? Am I chasing price if I try and enter a buy? But we have this daily fair value gap here, and that's just the midpoint, right? A previous day's rally doesn't mean look for a reversal. Just keep looking for the origin of price delivery, and the better you get at identifying PD arrays, like the 30-minute order block in between the two fair value gaps, the better you will get at recognizing them ahead of time. So coming to the chart, we say we found the 2-hour FEG, the 4-hour FEG, and this 30-minute order block. So we don't know what's going to happen yet. Price looks like it's falling pretty sharply. Not really sure, you know, where buy side liquidity is, you know. But anyway, price, it's still within this 4-hour, you know, green box. Gets very close to the mean threshold of the 2-hour. Perfectly touches the 30-minute order block. Right, so that kind of explains why price had to go past this mean threshold a bit to reach this order block, and didn't quite hit the mean threshold of this imbalance here. But that's okay, because we've built up a little narrative now around, you know, why price went there, why it went past here, why it didn't quite get to here. And yeah, as soon as that happened, as soon as I saw this happen on the 15-minute, I went down into a 2-minute. Unfortunately we can't see it, but I would have just found, you know, the smallest market structure shift, any fair value gap. You know, it must have been like a 3 or a 2-minute, 5-minute fair value gap. We can't see it here because we're on the 15-minute. Then I just put the stop loss just below the order block here, and yeah, there are a few pullbacks. I think the stop loss was maybe about, say, 16 pips or something. A few small pullbacks, got a little bit nervous, but it never created a market structure shift lower. And then, yep, we target a pretty ambitious target, actually. Originally, I was going to go for this as the low-hanging fruit. Then that's the next sensible target, and I actually just went for up here. Having the context of a daily target is what prevents you from having a short bias during what is actually another bullish expansion phase. So since we had this the daily fair value gap mean threshold here, I was sort of anticipating that price might want to go there. I didn't put my target up there. I just went, but it, you know, it allowed me to go from a more ambitious target than just low-hanging fruit, because, you know, we've got this whole context now. So yeah, things are improving, and okay, this is where we have a few we have a loss, a win, a missed. So this is, again, it's on TradingView. I didn't know what was happening, you know, I was going through it as though I was blind, as though it was, you know, trading. So that's why we get, you know, a loss, a win that we never managed to be a part of. So, you know, it helps to show you that it sort of pseudo real trading, I guess. So at this point I'm right, you know, we'll start on the weekly, then we'll go to the daily, then the 4 hour, 2 hour, 1 hour, 30 minute, and we'll mark out every PD array that we can. So we start here, right, before we've seen all of this, and we see prices coming from this bearish PD array here. So okay, price is bearish, but I'm also, you know, not sure if price is going to respect this level and then go bullish. So I wait. Once this is violated quite clearly, then I note the buy side liquidity down here, and I think, okay, now that this is violated, this is the origin, price is heading towards the buy side liquidity, gets very close to it but doesn't quite grab it, and then starts making a retracement. I see this 5 minute fair value gap, and I just decide, you know, I'm just going to enter. Might be wrong. Enter, and it keeps going up, goes past the stop loss here, and so, you know, that's a loss. But then I'm thinking, okay, that makes sense, but we're still haven't taken that liquidity, and we're still originating from here, and this move was originating from here. So I simply say, okay, well, I think price, the 5 minute fair value gap wasn't strong enough. I'm going to instead just anticipate that this 15 minute fair value gap is actually where price was going to go, and I'll put the stop loss at the previous high. And to be honest, if I'd got stopped out, and then I would have probably sold here again, because that's how confident I was that price was going to go down. So yeah, price goes there, immediately comes down and takes the buy side liquidity, you know, touches that mean threshold of a 30 minute fair value gap. Once I see that happen, once I see this whole narrative play out of, you got the buy side, you corrected the imbalance, you've still left an area of liquidity on the table up here, didn't quite take it. So this liquidity is where we're going to be targeting next, you know, coupled with the 30 minute imbalance up here. So as soon as that happens, I say, well, you know what, I'm just gonna try and end here. So I put an order in here, I see price returning, and I think, okay, it's going to fill that order, but it doesn't quite reach there. Starts going off, and then I say, oh, you know, actually, I've just seen there's an order block here. Okay, so that would have actually been a better entry, or we could have used this fair value gap here, you know. But at this point, I was still, you know, doing measurements from the high and the low and trying to get the optimal trade entry based on, you know, I want price to pull back into a discount before it goes higher. But I've actually scrapped that as well, in favor of this narrative. So I've put this as, well, let's just go through. So price originate from 30 minute SIBI. 2, I wait to see how price would react to this 1 hour FEG. The FEG was violated and price stopped short of the external buy side liquidity. 3, I targeted the 5 minute fair value gap and then the 15 minute fair value gap, which also had sell side liquidity targeting buy side below. Once the buy side liquidity had been taken, I attempted to enter on a pullback, which didn't quite get filled. Nevertheless, the logic behind the trade idea was still correct. In hindsight, the bullish order block was a better entry. Okay, so we're actually like getting to the point where we're starting to understand the concepts now. And this was the latest shenanigan. I think this is, yeah, day 9. So this is what I did today. Okay, so price moved quickly but still respected the daily and 2-hour fair value gap SIBIs. We've got two mean thresholds of a daily and a 2-hour right next to each other. They have already been respected off screen in the past. Price wicks in between them, sort of like a, takes this sell side liquidity, stays within the mean threshold of these. Very strong signal. I was a little bit concerned though, because this was a big spike. I was like, is there some crazy volatility I wasn't aware of? But then I see this happen. I see price come to within precision 1 pip of buy side liquidity, and that just isn't a coincidence. So I was a little bit confused. I was like, what do I do? Should I be buying? I mean, that was liquidity, but then I realized no, hang on, price needs to go get this buy side liquidity here. It stopped short of it deliberately so that it could come back up for some reason, I don't know why, before going down again. So I saw this 15-minute fair value gap here. I entered there, saw how large the stop loss would have to be. So instead of using the wick, I instead just used the body of the candle that created the fair value gap. Obviously that was a mistake because price came back up and did this thing where it goes like halfway up the wick. It's called a constant encroachment, and then it went and smashed through that liquidity, made new lows. Price left the external sell side liquidity unbroken to the pip, so I anticipated a pullback before a price drop to that level. Because of the volatility, I hesitated to put my stop loss at the previous high, which resulted in being stopped out just before the real move. Once again, the logic behind the trade was flawless. Using the concept of liquidity and origin of price allowed me to make sense of the price action. Therefore, I have included the stop loss placement as a rule that must be followed to simplify the process. 3. The stop loss must take into account the possibility of a constant encroachment. 4. If buy-side liquidity resides directly above a higher time frame PD array, there is a strong possibility that price will return to that level. That doesn't mean will reverse at that level, but will go there, which is why that's where I placed the profit target. So let's go through this based on the rules here. Sell side liquidity taken. Yes. Here and I wanted to see that with a body, but this sell side liquidity was taken with the body, so technically that satisfies the sell side liquidity closing above an equal high. Buy side liquidity hasn't been run, and no, it took me a while just to double check it, but that wick is not taking buy side liquidity yet. Okay. 3, a market structure shift, and so this wick here is a market structure shift. And then most importantly though, confirm the market structure shift isn't just a rebalance of a previous higher time frame displacement. For example, if this wick had instead come at and touched the mean threshold of this 30-minute inversion fair value gap, then I probably wouldn't have had the confidence to enter this, because I would, I'd be a little bit concerned that, I mean, this is the 30-minute inversion fair value gap, but price is delivering from a 2-hour and daily. So technically this should overpower this, in terms of numerical superiority, like, a card game or something. Oh, the 2-hour fair value gap beats the 30-minute inversion fair value gap. So that's the whole idea behind that, basically. A bearish point of origin, yeah, we've discussed that. Stop loss at prior high. This here, I've now said the stop loss has to be at the prior high, just so it makes it easier to follow the rules. And yeah, that's all I got so far. Feeling a lot better about this. It's still very similar. We've still got we've got an actual explanation of a market structure shift. We've also added this piece of text to the daily bias. Price must be Originating from a bearish PD array, the candle bodies should be respecting the mean threshold of a fair value gap SIBI. If price is delivering from a 1 hour fair value gap SIBI, then it trumps a 15-minute fair value gap BISI. Rather than just a bunch of arbitrary, is price below the New York Open or is it above the New York Open, then you sell. Rather than being just arbitrary, this is kind of based on more like logic that you can make sense of to help a narrative. So that's what I'm going to continue to practice, and tomorrow it's a new week, so I'm going back into my funded evaluation with this refined approach. Hopefully see some better results now. But yeah, thanks for watching. Let me know if you have any questions. Bye.